Okay, well, we're 6:30 now. My name's Chris Weston. I'm head of research at Pepperstone here. Just want to quickly do a sound check. I know I did one before, but I just want to double check that this is all good for you guys. So if anyone could just reply back to the questions area and just say, yeah, it's all sounding good, or if it's not, let me know. So can everyone hear me okay? Cool. Yeah, getting a few people now. Brilliant. The sound is good. We've got a new microphone, so it's hopefully crystal clear, but we'll crack on. Okay, so today I'm going to talk to you a little bit about combining fundamentals and technical analysis. Now, I'm not going to talk about equities because I think that deserves a whole sort of new subsect of fundamental analysis. Traditionally as an investor, you would get a set of expected cash flows, and you'd discount those cash flows back to a present value, and that's where you'd, if you're an analyst, get the net present value of the stock. If it's trading at a decent 10-20% discount to your price target, then you'd put a buy rating on the stock. Rodendo, yes, this will be recorded, so you will get this automatically sent out to you. GoToWebinars, which is the software we're using, will automatically send it if you registered. But yeah, I mean, if you want to get in touch with me through Twitter, my handle's Chris Weston at _Pepperstone, so Chris Weston _PS, sorry, or just reach out to me, Chris Weston at pepperstone.com, and I'll be able to send you the recording of this should you so wish. But yeah, as I say, we're not really looking at the fundamentals as an investor. We're looking at this in the trading scenario, and really what I'm looking for is this kind of top-down macro scenario that I think markets work in. We get fixated on an event. Everything's deadline driven these days, and I'm going to talk to you about sort of the macro investing in macro trading world. And how you can use news flow, psychology, sentiment to really kind of think about a different way about thinking about the market. Obviously, we combine our technical analysis and price action around that. I think everyone who's in this room absolutely has to have an understanding about technical analysis when you're short-term trading. When I say short-term trading, I'm 5-minute charts. I'm talking hourly charts, daily charts. You can even use weekly charts to understand your setup. But it's about understanding the ebb and flow of the market, where the supply and demand is. What is the message the market's trying to tell you, and how does that ultimately lead into probability? And ultimately, I work on the idea that the markets are a set of random variables. Okay, fine, you've got people there who know a little bit more than they should, but we, in most scenarios, don't know that situation. So the markets are a series of random outcomes. And the way that we can think about markets is in probability terms, and that's what we do. That's what I do as a strategist. I'm a trader and I'm a strategist, and there's an overlap between the two. And what I need to do is I need to be thinking about things like the upcoming Fed meeting. What could be the permutations of that Fed meeting? What could this individual say? What could the statement say? What could the tone of it mean? And what could that mean for the US dollar? What it could mean for rates? What could it mean for the S&P or the Dow or gold, for example? And I'm looking at the different permutations and saying, well, there's a 25% probability of this, a 50% probability of that, and a 10% blah 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 probability of that. So I break down all the different event risks, all the different permutations about how that works, and look at the probability about how that's going to assess assets. And if it's too hard, then of course you'd just be looking to reduce your exposure. That's what I'm going to touch on today. Bit of other housekeeping though. Here's a link at the bottom here. You can see cloud.go Pepperstone. For people who aren't already on my daily that I send out, usually around sort of 2:30 to 3:30, feel free to sign up to that if you like the cut of my jib. It's kind of a global macro idea, giving you some thoughts around various trading situations that some people find fairly useful. So you have a go at that. You won't get a call from any one of our sales team or anything like that. So it's free. So do check that out. Okay, so I'm looking to combine fundamental and technical analysis. Why? To give us a better understanding of markets, to help us with our probability assessment. Okay, so the first things first, I think this is a chart that I put out recently in a recent webinar. And again, it's before I start talking about the journey, the cycle that we go into in trading, we need to understand what causes the volatility, what causes this three-part stage journey that I'm going to talk about in the next slide. And for me, we go sort of Maslow's hierarchy of needs, but we can put this into the hierarchy of volatility. And for me, the biggest driver of volatility, the biggest driver of uncertainty is politics. Look at Brexit at the moment, and I'll talk a little bit about Brexit at the moment. Look at what happened with the Trump election. Look at what happened in so many of these different situations, be it the European debt crisis to 2012, 2014. We sort of saw a situation through the European debt crisis, actually, where so many investment banks, so many buy-side institutions, the pension funds, who failed to adequately price risk around these kind of events, that they started hiring ex-politicians. The amount of ex-politicians who now work in relationship management positions or strategy positions in banks with the idea of trying to get them to understand and bridge the link between politics and financial markets. And generally you see a situation where markets just fail to price risk. They fail to understand the connection between a certain variable, a certain event, and ultimately what that can mean for market pricing and how you hedge that exposure or speculate on that exposure. And so therefore, for me, the idea of politics continues to be the biggest driver, and you see a deadline being imposed, and that's what we're doing. We're a series of deadlines that come through in markets. But with Brexit, is that there's a series of deadlines within deadlines, and there's a view of how markets trade into that deadline, how it trades around that deadline in that sort of 12 to sort of 24-hour period, and then what happens after we see that situation. So for me, politics is arguably the biggest driver. Politics can change fiscal policy. It can change ultimately how monetary policy settings goes, and therefore that to me is the biggest driver of volatility, and that's going to be where we see these various cycles coming through. And that's why for me, I've had to get a much greater experience about how politics can shape volatility and how we trade volatility around politics. Then we've got liquidity and financial markets. Now, I touched on this in the last webinar, how the markets effectively bullied the Federal Reserve into where we are at the moment, and there's no doubt that we have seen the market test out where the Fed are in terms of, let's sell off risk, and the S&P dropped, quite aggressively down into that Q4 period. From October into December, oil prices got hit pretty badly. You obviously saw the rates market pricing in a decent degree of cuts going forward. And we saw liquidity coming out of the market. There was a big drain in fund flow. And the markets, effectively bullied, they heard Jerome Powell's message in October, said, we don't like to hear that. We think we're seeing a slowing economy. We can see that now. And you want to continue putting up rates, and you want to put the balance sheet normalization program on autopilot. Well, we don't like that message, and we're going to react. So the financial markets reacted very aggressively. And what we've seen over the last few weeks has been very, very aggressive. The Fed have done a 180 turn. We're now hearing talk that they're going to probably hear in the May meeting, maybe the June meeting, that they're going to announce what we call the terminal size for their balance sheet, which will effectively show us that the quantitative easing program will finish early and finish at the end of this year. Better liquidity conditions. The ECB in the March meeting on the 7th of March are probably going to impose or tell us that they're going to issue a new round of targeted long-term refinancing operations. So cheap liquidity to the banks, and the banks in Europe are looking pretty good at the moment. The PBOC themselves, after seeing markets going down, economics retreating, have turned on the credit taps again. We've got MT money supply now at 8.4%. You've seen new yuan loans recently coming out on the weekend at the highest levels they've ever been. Effectively, financial markets move, they tighten financial policy, and of course we see the what we call the price maker central banks, the ECB, the PBOC, and the Federal Reserve, or the other central banks kind of evolve around them, reacting, and they've had to react. So I think financial markets and the liquidity which drives financial markets is something that can dictate how central banks think as well, and that's what we saw in December. So I continue to think broad financial conditions can bully central banks into changing their view, and that's exactly what we've seen. Economic data, by its general situation, is a lagging indicator. We often look at unemployment, But if you think about the way that unemployment works, it's actually one of the last things to react to the business cycle. So the first things we think about is credit. How does credit influence, the discretionary spending? How does it affect house prices? How does that affect your wealth situation? How does that affect business sentiment? And then you get, obviously, if business sentiment drops too sharply, as a result, you end up seeing higher unemployment. So economic data can promote central bank actions, but at the same time, it's generally a function of lower liquidity, a deterioration in financial markets, be it equity markets, be it house prices. Central banks react, economic data transcends, and then forget about analyst forecasts. We won't talk about that too much. But this is really what we've got to think about. This is how I think about the situation is, when I'm thinking about trading, I'm not thinking about investments here, where the best thing you can do when you're an investor is just not look at the markets so often. If you've got a portfolio of diversified shares, different asset allocation, maybe you've got some fixed income in there, maybe you've got some commodity exposure, whatever it is, the best thing you can do is stay abreast of the situation, but not look at the markets every 5 minutes. That's what we do as traders. But what we're trying to do is we're trying to understand what is the key thematic that's making markets move, and how does it fit into this triangle, this hierarchy of volatility. If it's those bottom three ones, central banks, liquidity, financial markets, and politics, what is the key determinant that's ultimately making market pricing work? And therefore, if I'm looking at politics, for example, which we've got a fantastic case in point there, two case in points, with probably arguably the biggest one out there, which is the US-Sino relationship. Okay, fine, that's geopolitics as opposed to actually a political development like Brexit. But you can see right now the market is fixated very much on the US-Sino relationship, and the global economy has been deteriorating for quite some time. Central banks have had to react, and ultimately Donald Trump, if he wants to, could cause a decent reaction in markets either way. If he wanted to pull away and say to China, fine, you haven't done enough, we're going to put there's 200 billion of tariffs which are taxed at 10%. We're going to put them all up to 25%. Well, we saw some incredible research from the Institute of International Finance last weekend, which said that tariffs, which they had on the 50 billion tranche, which the US were now tariffing China at 10%, at 25% on that 50 billion tranche, were having significant impact. Now, if Donald Trump was to go and do the rest of the 200 billion at 25%, which the IIF said that the 10% that been imposed on them said there was actually a very small impact on that situation. Now, if they were to put that up to 25%, which he could feasibly do, then I think you'd see a significant impact on the Chinese economy, and that's having big reverberations on the European economy, and it's having big reverberations around the world. And China really is at the epicenter of that situation. So what's at the cause of that? Well, it's politics. And what's at the cause of Brexit? Well, I'd argue Brexit is very much an idiosyncratic event. It's very much 90% of the variabilities around the pound and the gilt market, and also to a lesser extent, the FTSE 100 and probably more so the FTSE 250. But again, if you're trading the pound, and I know there's probably a lot of people who are in this room, then you are really beholden to political events. So I really want to concentrate on these bottom three: central banks, liquidity, financial markets, and politics, and trying to understand the thematic which is driving markets and what stage we are in that journey, and what could be the event risk that's coming up which could move markets, and what markets do we want to be in which are going to be sensitive to that, and then apply a technical overlay around that to say that the market's on board. So that's really what I understand is, what is the thematic which is driving markets, and how does it fit into this kind of hierarchy of volatility? So I talk about this economic cycle, this trading cycle, and this is a very simplistic situation. But let's say this middle one, stage 2 here, is the event deadline. Now I talk about, something comes onto the radar. I'll talk about the US-China relations. We know that the trade tariffs, the deadline for that is the 1st of March. Now, are we going to meet that deadline? Probably not, but he's probably going to extend it. But he might not. Ultimately, we have a deadline. We've got Brexit. Ultimately, we've got a deadline. That deadline is the 29th of March. That's when the UK will leave the EU. And if no deal is formed by that time, then the UK will go to WTO standards. And I think on the weekend in the Daily Mirror, we saw that fish fingers are going to double in price, and there's going to be roadbacks all the way down the M25, and the UK economy is going to collapse. They're going to be handing out rations, but we have a deadline, and that's kind of what we think about. We think about the US presidential election, we had a deadline, and we have polls within that deadline which create volatility. But we live in a deadline driven world, and we work on a situation where, if you think about what is it that goes into that, where is that deadline within the hierarchy of volatility? The further down that scale, probably the bigger the event's going to be, and usually that's going to be a political event where there's such uncertainty that we can't price risk. You see volatility structures working very nicely in that situation, and that can be unwound very quickly. So we have a deadline. Now, what we've got to think about is how markets trade into the deadline, how it trades around that deadline, and then ultimately what happens after that situation. So the way that I think about this is the event hits the radar, some way out. The event becomes a thematic. And the market's trying to understand the different probabilities. What are the different scenarios that are playing through? If we take Brexit, for example, there could be a second referendum. I doubt that's going to happen. There could be a deal that's formed and someone could blink at the last minute. And of course, that would be good for the pound, depending on what it looked like. We could see no deal coming through. And that's a rising risk at the moment, given that we're getting closer and closer to the deadline. But ultimately, in this first stage here, we're trying to understand, after the referendum was formed in 2016, what could be the deadlock, what could be the ultimate end goal, and what assets are going to be sensitive to this, and what are going to be the different probability trees that come through there. And then the games are decided. Now we have these series of kind of votes that come through, and then volatility starts picking up. And unless we get a really clear situation that is formed at the moment with things like Brexit and to a lesser extent the US-China relations, that we don't really have a particularly clear picture. I think with US and China at the moment, it's very much they're making the right kind of noises, and we're running the risk of a kind of buy the rumor, sell the fact. But we are in a situation where especially with Brexit, that we're getting no clearer to that. And if you look at implied volatility in the pound, in the options market, it's the highest of any G10 currency, and that's no surprise that a lot of people have hedged their exposure. And if we don't get a good deal, then absolutely, you're going to see people ramping up those hedging exposures. People don't know what the outcome of what the UK economy looks like in 12, 24 months, and they start selling the bejeebers out of UK assets because they just don't know what's going to happen. Now we get that volatility, that situation. Now let's say we've got an election; it could go either way. This is the period that I like to stay out. This is the period where a lot of retail traders will like to trade, because it's you get these big whippy moves. But this is the period where I would tend to stay out. I mean, whether you have one event or you have events within events. For example, on the 27th of July, we have the next meaningful vote in Brexit, and depending on how that goes, could cause big volatility in the pound. I mean, it answers questions that gives us that clarity about what the end goal looks like. Everything's about getting the clarity. With fundamental trading, we're trying to understand and get the picture of what something looks like in the future. And every event that comes through answers questions for us. It gives us a little bit more of that jigsaw that answers the thematic that's in the market. Now, around this kind of period here, this is the time when liquidity becomes scarce. You get brokers and sell-side banks and investment banks pulling their bids, and you have stop hunting and all this kind of craziness that goes on through the markets. But it does cause crazy volatility, and that for me is just why I stay out of these events. If they're outside of your control, it could go either way. That's when I'll be looking at the event risk going forward. And part of my risk structure, the process that I have, is understanding, do I have a high probability around this event? It could be a Fed meeting, it could be an unemployment report, that's something that I just I can't quite grasp. And I say to myself, well, I've got an exposure around that. I've got a dollar exposure, I've got a gold exposure. It's going to be sensitive to this event. And do I want to be involved in, and do I want to have that exposure around something that could be pretty crazy? And to me, in a lot of the situation, I think it's very prudent to trim back on some of that exposure, because I'm a manager of risk. That's what I do as a trader. I'm trying to understand, do we have a high probability outcome around this volatility event, and how does that feed into the overall thematic? And in quite a lot of the cases, I'll look to try and reduce some of my exposures going into those events. What we do is, once we've actually got the outcome, once we actually know the fact, sometimes it won't be fully answered. We might get a hung parliament or whatever it's going to be. But let's say we get the fact. What we've now got is that that closer towards clarity. That's what you hear this saying in the media, that markets hate uncertainty. Of course they do. They want the answers. They want them now. And the idea is what happens is, once markets settle down, they find themselves a fair value in the market. They kind of try and understand, what does this mean for the future now? Now we know this outcome. What does it mean for confidence in the economy? What does it mean for monetary policy? Has this changed the dial that the Bank of England are now going to have to ease, or are they going to hike, or is the Fed going to be more closer towards hiking now that we've got this certainty around the political event? And what happens is, now we know the fact, everyone makes these really quick assumptions of what this looks like in the future. Now we're pricing this in real time, and that's when you get this real whippy price action coming forward, reversals occurring, as I say, whippy price action there. The market's trying to understand what this means in the future. Market is trying to find a fair value, and that's what you see on technical analysis when you're looking in the chart patterns. If you've got a market that's trading sideways, like the euro dollar has been for some time, let me bring that up. You've got this period here where you can see between October and January in euro dollar, where I'm not going to go through the political situations, but why did the market trade when a 113 or a 114 handle for something like 60 days? It didn't want to leave one of those two handles. And you can see here from the Bollinger Bands narrowing, you can see by the 20-day moving average, which of course is the mean of this volatility measure, realized volatility measure, moving pretty much sideways for a long period of time. It moved up a bit here, but you can see that the market has found a fair value. I'm looking at a chart and I'm trying to say, what does this tell me? This is like the matrix. It's a roadmap of supply and demand. But I can have a fundamental picture, and I can tell you exactly what's going on at any one time here. But the chart is telling me that they think this is a fair value. When we've got a market that's going sideways, it's telling you that the market's found a fair value, and that neither the bulls or the bears are prepared to push price around. And that's a nice way. I mean, I've got a lot of guys here who like to range trade, and that's fantastic. If you've got a strategy around range trading, then you've probably done very well around euro dollar. You've found the conditions, and that's probably broken down now. But you saw for a large period here, the market found a fair value, and that's kind of what we saw. Okay, so then we've got a situation where, once we actually start seeing what this actually all means, you see a situation where trends often form, and this is where I really like to be in. This is for me the best bit of a cycle. After we get a core thematic, be it the rate, the Fed needs to, we've got a Fed meeting, the Fed are likely to change rates. They might not, they might do, but then they decide to do so, and then the market understands what that means. Are they likely to do it again? The dollar now is going to be sold off. But when everyone starts thinking exactly the same, this is when trends form and then volatility subsides. So for me, in terms of a market cycle, a trading cycle, should we say, when we fixate ourselves on a specific event, then the best place to actually be in that cycle, I think, is once we've had a chance to understand what this means, and we actually understand what the outlook looks like, and everyone starts acting the same. If you're an Elliott wave trader and you're looking for that sort of third wave up, that body of motion is going to happen probably around here. It's going to happen when everyone starts looking for trends. If you're a momentum trader or a trend trader, when everyone starts acting as a collective, it's going to be around this time here. It's going to be when everyone starts thinking the same. And when everyone starts thinking the same, you get uptrends or downtrends, and the reversals or the pullbacks in those moves are very narrow. And that's kind of what we're doing. So let's give some examples here. I mean, I think I brought up to Brexit, but let's look at this in reality. And what I've got here, rather than actually looking at cable, which I can do, I can look at cable easily, and I will do, is actually looking at the options market. And what I've got here is a Bloomberg chart of 1 month realized volatility, which you probably would have looked at quite closely using something like the average true range, or maybe even Bollinger Bands that uses realized volatility. This is the volatility that's happened. But I tend to look at implied volatility, and this is the options market saying, we've looked ahead at everything that's going to happen over the next 1 month, and we think that the volatility is going to be here relative to the mean. So it's implying, it's forward looking, and I like to look forward rather than backwards myself. So I look at use and forward implied volatility. But you can see here, again, we go into those stages. I think, we had the Brexit referendum in 2016, which I've highlighted in this dotted line. But you can see markets are fairly calm. Yeah, implied volatility and realized volatility was fairly calm for large periods of time. But of course, as Sunderland and Newcastle voted to leave and Brexit, everyone went, oh, that's not supposed to happen. And again, massive political event. Look at implied volatility goes up to 50%, which is as high as it's ever been, I think. And yeah, people were like, that's not supposed to happen. And then we saw that, the pound having a sizable move as well. I mean, I think I've probably got that somewhere. Yeah, I've got it on a weekly chart there. So you can see the move there, which is nicely put on this green line here. We saw it going from what, 129.49 right down to 114. So yeah, it's a massive move coming through in the pound, although it recovered quite nicely after that situation. But you saw a situation here where we actually had the vote, and I'll talk about not trading around the event. Well, look, this is that 24-hour period around it. Look at implied volatility went absolutely bananas, up to 50%, and the pound dropped absolutely staggering. So it's great if you're on the right side of that, and a lot of people were on the right side of that. But then what happens is we have a period where we now know what happens. We know that there's a long lead time, and you can see implied volatility settles down, and you see these kind of small spikes that happen in between there. But ultimately, we kind of understand what's going to happen here. And this was an event where, we had a deadline. The event proved out to be completely against what most people in the market had been anticipating. But now we kind of understand what's going on. Now we're back in that same situation here where you can see that the deadline is the 29th of March. We're in stage one. We're trying to understand what this all looks like. And the permutations about this are the situation. But the point here is look at the way that we're thinking about markets. How does markets trade into an event? How does it trade at the event? And then what happens after, once we know the fact? And there's probably a great example here with the 2016 election. I know plenty of people out there who say, oh, I predicted Donald Trump would win the election. Yeah, but did you actually predict that the markets would do what they did? And I mean, if you look at the S&P futures, we went limit down on the day. I've got a daily chart here. I think it's a daily chart, could be a weekly chart. You can see this massive move down in the S&P futures during the Asian time zone. But as soon as Donald Trump stood to the stand and he didn't declare war on North Korea and all those places, and actually sounded reasonably presidential at the time, we saw this massive bid coming into equity markets. Now, no one predicted that one. I think people predicted Donald Trump would win. But if you look at that, the spike up in the VIX, and then that settled right back down. Volatility subsided. He decided to cut corporate tax down to 21% from 35%. Look at all the money going into the market here as companies use that to buy back stock. It's something Marco Rubio is just trying to ban at the moment. But look at this. Had anyone anticipated that we would get a monetary policy easing at a time when we were going to see a massive fiscal plan? It's not what they teach you at school. And Charles, you can download the webinar. I'll send it out to everyone on this, or it'll be sent out to you anyway. If you want a copy of the slides, do reach out to me, Chris Weston, chris.weston@pepperstone.com, and I'll send them over to you as well. But yeah, VIX, the volatility of the S&P, the 30-day implied volatility of the S&P settled right down, and you can see this massive move. And this goes again into this situation where we saw markets trading into election. It didn't get the result that most people had anticipated. But then even if you had anticipated this, had you anticipated the reaction in financial markets? So again, it can be very difficult to do. But what is the common thematic behind here? It's we have a market cycle. We have a date, which is the election. Markets trade into that date. We have a whippy, crazy period around that event, and then markets understand what the future looks like, and we see this massive trend. And this is the part that I want to be involved with, when we understand a little bit what the future lies, and everyone acts as a collective body. So think about the deadline. What is it, the key thematic that we're talking about? Is it US-China relations? What's the deadline? How's markets going to trade into that? And what is the key things we're looking for? Is it going to be individual dates of a new election? Is it going to be, something that changes monetary policy? What is it going to be? Understand that core issue, and then that's the situation that markets trade off. Okay, so in terms of I've talked about the journey that we go on. What I want to understand is the fundamentals in trading. Now, as an investor, the fundamentals I look for are very different from the fundamentals I look for in trading. And if I invest in fixed income, for example, I want to understand the expected cash flows that I'm going to get from the bond. What coupon income am I going to be getting? And if I discount those coupons into the future, what is my cash? What is effectively the net present value of that instrument when I discount it using a risk-free rate? I mean, this is there is a theoretical fair value for the fixed income market, which is discounting the future coupons and interest payment of the life of that bond using a method to discount that. Now, I'm not going to go into economics and applied finance, but the same situation is true with equities. If you're an equity analyst and you're covering Cochlear, for example, you're going to go out and you're going to work on a set of assumptions, be it what's the Aussie dollar rate at the moment, what do we think about economics, how does that impact the sensitivities of their revenue numbers, what's going to happen to the US economy, the European economy, blah blah blah, and you'll get a set of expected cash flows based on your model. What we'll then do is we'll have a weighted average cost of capital, which I won't go into that too much details, but we'll work out what the weighted average cost of capital is. So we'll then discount those cash flows to get us a net present value, and from that situation we can work out what our price target is going to be. But everything is based on a set of assumptions, and if one of those assumptions is wrong, then your whole model is completely out of whack. And that's why price targets, when you see an equity analyst, are always wrong, because one variable in that model can change the whole dynamic. And if they get the Aussie dollar wrong, then that's going to have big impacts on what they see as the price target. That's why we never look at, or in theory, we never look at analyst situation. But what we're trying to do is we're trying to say, as an investor, these are the fundamentals that we're looking for. But in trading, it's very different. As a trader in a short term, I'm trying to understand what news markets are sensitive to. Whether I'm trading the Aussie dollar, whether I'm trading the yen, whether I'm trading the US dollar, whether I'm trading gold, what is that market absolutely sensitive to? And therefore it means something to me. So even if you're trading an EA, for example, having an understanding about the backdrop that your EA or expert advisor is operating in, and then having a look out to the outlook and saying, well, actually, do you know what? I'm running this EA that works in a really low volatility environment. It works really well in the range trading market, but I think I've looked at this and I think there's an event that could cause some massive volatility. So, EAs are not artificial intelligence. They will not react. They will do as if they're supposed to do, and they won't change. So, one thing we see, for example, with automated trading is the idea that people's models work really well in some conditions, but when those market conditions change, then they keep them in the market, and of course their account then does pretty badly on the back of that. So even if you're running a discretionary strategy, even if you're running an automated strategy, the idea that you understand, if you're trading these markets, okay, fine, if you're trading 5-minute charts, it's good to know event risk, so that you can you don't want to trade around that situation. So I think even if you're a technical trader or a systematic trader, having an understanding about what the news cycle and will it be a volatility event, will it not be a volatility event, and how will it affect your strategy is really important to me. So as I say, understanding what a market is sensitive to. Do I want to be involved in that market? Do I want to turn my EA off? Do I want to increase the size of my expert advisor or my strategy? Because I think that these market conditions are really great for what my EA is trying to achieve, or what it's going to be. We're trying to get a sense of the structure and the pulse of the market. So we just want to understand, where we are in this cycle, how we feel about, volatility, and what is the market absolutely saying. So we're trying to understand the dominant thematic, and then what we can do is assess the best vehicle to trade. So what I'll do is I'll look at, in the next 2 weeks. So let's say in the next couple of weeks, we've got the ECB meeting on the 7th of March. Now, I think to myself, the European economy has been really bad recently. They've announced, a number of people have announced that they might do these targeted long-term refinancing operations where they're going to offer cheap liquidity to the banks effectively, even though they've said that they don't really want to bail the banking system out. And I think to myself, okay, so what is it, the key thematic here? And okay, again, it's better liquidity in markets. But what are the markets that are going to benefit if on the 7th of March, Mario Draghi comes out and announces this unlimited amounts of capital that the banks can tap from the European Central Bank? Now I think to myself, okay, I think there's a pretty good chance they're going to do that. We've seen, Benoit Cœuré from the ECB announced that, that there's a good chance that they are discussing this. So I think to myself, when I got the ECB meeting, firstly, what's the chance of them actually announcing at this meeting or giving a really clear indication that perhaps in the May meeting they're going to do it? Well, I think it's pretty high. So I'd say it's probably 50-50. But if I think it's 100% that they're going to either announce it in the March meeting or the one after that, in the April meeting. And therefore, I say to myself, well, what's the two assets that are probably going to be most sensitive to that announcement? Well, first of all, it's going to be the euro for me. And the second one is probably going to be the MIB in Italy or maybe even the DAX. So I'm picking out those two assets that we offer clients. And then I'm saying, so I'm just trying to choose my vehicle, which I think is going to be the most sensitive. Now, of course, if you are really quite into your stats, there are things we can do. We can run regressions, and you can pull out all the data of what's been happening in the euro, and you can pull out all the data and actually work out what the most sensitive to that situation. I'm very lucky. I've got a Bloomberg terminal. You can do a lot of that for it. But yeah, as I say, this is what we're trying to understand with trading, with investing with fundamentals. You're looking at the future. You're trying to understand the sensitivities of those of its earnings and then discount them back to the future. But as a short-term trader, we couldn't care about any of that stuff. It really doesn't affect us too much. What's important to me as a trader when I'm looking at fundamentals is the fund flow in markets. What are people doing? You can look at the ETF market. That'll tell you what people are doing. Market internals. I'm looking at liquidity. I'm looking at positioning. I'm looking at sentiment readings. I'm looking at overall performance. I do look at valuation from time to time, and I look at correlations in markets. So for me, as a fundamental trader, these are, I think, are the most important situations there for us to look at. What are the funds doing? And you can see this in the ETF flow, for example, or the ERPF do a good fund flow data. What are the big pension funds doing every week? What's the liquidity in market? What's the internal market internals? What's the positioning like? You can see that in the options market. You can see it in the commitment of trader report. Sentiment readings. If you can go to the CNN fear and greed indicator, and that will tell you a little bit about the sentiment in markets. We can see in performance. Valuation's interesting because valuation will lead to all of this assessment, which leads to probabilities. So if you've got the market trading at 18 times, and that's the highest level it's been for a while, you've got to say to yourself, well, as part of this overall assessment of fundamentals, is there something now that's going to cause this market to re-rate, or is this is this the highest people are prepared to pay for this on a valuation perspective? And when you get the idea that there's no way, that very low probability that we're going to see the positive earnings upgrades, that this is a multiple for the market that I think that they're about as high as they're prepared to pay. And therefore, you've got this kind of probability assessment that you just really can't see markets paying up. They're expensive. What's the next leg? Well, it's probably down in that situation. So valuation is important for me, but only really when it's in extremities. I mean, if you look at the AX at the moment, it's trading on 14.5 times forward earnings. Okay, you've got a bit of a valuation premium built into that situation. But it's not really, it's trading around sort of the longer term average, and therefore you can't really say that it's really causing too much of an issue. So they're the things that I would look for to give me a sense of assessment of probabilities. Everything is about probability in trading. You don't have an edge unless you're thinking about how the probabilities in each forward-looking situation works. And what I'll do here is I'm saying fundamentals, market internals, the number of companies above their 50-day moving average, above their 200-day moving average. And you're trying to understand, is the market overbought? Is there too much enthusiasm? Is there too much euphoria? Is there too much pessimism built into the markets? And that's kind of what we're looking for is you can read these, and that's what I look for in the fundamentals in trading. We're trying to understand what markets are sensitive to, and we're trying to understand how markets are positioned to give us an idea about probabilities going forward. Now in FX markets, and I know there's a lot of guys here who are fundamental are trading FX markets. What we'll look for as a fundamental FX trader are relative rate differentials. We're going to look for yield curve differentials. We're going to have a look at cross-currency basis swaps, which are really the cost to get dollar funding, and if they, that could have big implications on the US dollar. We can think about positioning, again, feeds into risk reward. And then we can have a look at measures of volatility. I've done a couple of webinars on using volatility, realized and implied volatility, to understand, measures for what people see about events going forward, but also how we can use that for our risk assessment as well. But when you've got a sell-side bank, for example, who does some analysis on the Australian dollar, when they're trying to model FX markets and currency pairs and understand what where price is relative to their model, which is a fundamentally driven model, they're going to be using relative rate differentials, yield curve differentials, and all these issues. It's pretty complicated stuff for the average retail trader. And the problem, and I'm guessing a lot of you are asking, is how the hell do I get this information? And that's something that is absolutely true as well. I won't go into that. Okay, so fundamentals ask the why. Why is this happening? Manfred, I'll certainly I'll get into those positions in a minute. So fundamentals ask the why. Technicals ask the what. And technicals, I think we can talk about all of these various factors, but technicals and price action actually aggregates all of this information into the chart. That's why when I'm looking at when I'm talking to clients who are really green, who haven't been in markets for a long time, I'm saying, look, just don't even think about the fundamentals right now. The best thing you can do is get an understanding about technical analysis, get an understanding about price action analysis, two different things, because all of this, everything you see in the chart is reflective of what fundamental traders are doing. It's aggregating all the news into one chart, but it's the idea about reading the chart correctly. What is the message they're telling you that I think a lot of people don't actually fully understand and ascertain? So when I'm thinking ahead, I'm trying to understand what the key thematic is and where we are in that cycle. I want the technicals to tell me that they're on the same page. What's the market saying about these fundamental actions? What are the markets saying in the news flow, and how they're pricing this in? And how is the collective body, the supply and demand you see in the market, acting as one unit? What is the market telling me about my view on this, and whether I'm right or wrong? What is the message the market is portraying? So technicals look at the behavior, the pattern, the flows, the trends you see in the market. It aggregates all the various players that are in the market. Whether you're talking about reserve managers who trade and manage money on behalf of central banks, whether it's exports, whether it's real money accounts, guys who are insurance companies, for example, who might want to neutralize or hedge some of that exposure out. All of these guys is capital moving around from one place to another at any one time. And a lot of that time it will be in fitting with a lot of the fundamentals that I talk about. We talk about Brexit. How's the pound trading? How are people, businesses feeling comfortable about that situation? What could the Bank of England do? If we get a positive resolution, they're going to raise rates a lot sooner than people had been anticipating. All of that situation is reflected in the fund flow. All of it is reflected in the technicals, and you can see that at any one time. What I think fundamentals do is they help you get an increased probability about how that's going to go. So I'll talk about a case study before I'll talk about two case studies. The first one is understanding what makes something move. So I'll talk about the fundamentals here. And I've talked about on previous webinars the idea that a lot of traders who use fundamentals aren't even looking at the right situation. And that's why I think trading off fundamentals can be very, very difficult unless you actually know what you're doing. And I don't really want to do this whole webinar with the idea that it's just too hard at the end of it, but I just want to give you an understanding about how I assess the situation with fundamentals. Now, I'm looking at the Australian dollar. There's no real political situation that's around this, although it is being used, I suppose, as a vehicle let's take that back. There is probably a political situation. It's very much around what's happening in the US-China relations. So again, we go back to that. We go back to that time frame about what the Australian dollar could do into the 29th of March time frame or the 1st of March time frame when they're supposed to get a deal together, which, as I say, will probably get extended. So what I'm trying to understand is what is actually making the Australian dollar tick. If I go to this chart here, I've seen a lot of people coming out and saying, oh, the Australian dollar's a buy because iron ore's been going up. Well, there's fundamental sense in that, right? It's one of our biggest, it's our first or second biggest terms of trade with LNG. And therefore, if iron ore prices are going up, it's going to be great for our, government revenues and so on and so forth. It's going to put us in a much better position, fiscal position. We're going to be on a surplus quicker than specific, and the Australian dollar should be sensitive to that. Also, what I'm trying to do now is understand correlations in markets. So we can see here the iron ore price is in green. You can see the Aussie dollar price here is in white. And I say, fine, that makes fundamental sense. But is the Australian dollar actually showing any correlation whatsoever with the iron ore price? I say absolutely not. So, whilst I've got a lot of people coming out saying the oil price is going up, great, that's fantastic if you're in, Fortescue Metals or an iron ore stock. But as an Aussie dollar trader, do I care? Absolutely. To be honest, I couldn't give a monkey's about it, to be honest. It's not something that I look at. Why? Because the market as a collective body doesn't care about iron ore. You can see that there. There's at no stage is this showing any correlation whatsoever with the iron ore price. In fact, throughout this period of time, it's actually showing a negative correlation, which makes absolutely no sense whatsoever. So do I care about iron ore? No. As a fundamental trader, I'm trying to understand what makes this bad boy tick. So what makes it tick? Well, for large periods of time, the Australian dollar, you can see a fairly strong correlation with the Hang Seng up until really this point here when the jaws open. Now, I'm trying to understand why. We go back to the understanding of fundamentals. Why is something happening? Why would the Australian dollar have a strong correlation with the Hang Seng? Well, it's being used as a vehicle. The Australian dollar is being used as a vehicle to express a view on China and a view on emerging markets more broadly. But why would you go and trade China when you can trade what is effectively being used as the G10 proxy of China? Much cheaper to trade the Australian dollar than go and trade dollar CNH or one of the indices, for example. So people were trading the Australian dollar because 35% of our exports go to China. We are very much a leveraged play on China. And you can see there that the Australian dollar had a very strong correlation with the Hang Seng. So I'm saying to myself, what is the making it move? It's the field towards emerging markets. So we could see the Hang Seng was falling because we could see that the trade tariffs were working pretty nicely, and Donald Trump was getting these extra revenues. It was hurting the Chinese economy. The Hang Seng obviously a play on China there, and you could see that there's a strong correlation. That's broken down now. Now it's interesting to me as a fundamental trader to ask why that's breaking down. Why is it breaking down? The technical guys couldn't care. It doesn't really bother them whatsoever. They're trading price. The market's telling you everything you need to know in the price. But I want to understand, why is this breaking down? Again, we can have a look at the Australian dollar against the US dollar CNH, which is the offshore Chinese currency. We're just trying to get that clarification about what's happening here. And you can see here that the Australian dollar you can see it's falling, and I've actually inverted this. So you can see here that the Chinese currency is strengthening against the US dollar. The US dollar is effectively weakening, and you can see that there's a very strong inverse correlation between the two. So the Australian dollar, the algos are effectively locking on to the currency pair. So again, you've got that clarification that the Australian dollar is a leverage play on China. That's really, that correlation is still very true. If you're trading the Australian dollar, you've got to have your eye on dollar CNH. If dollar CNH is going up, the Australian dollar is going down. Of course, the core, variability, the core phenomenon there is the US dollar. But the US dollar CNH now is the most important cross in FX markets, especially ahead of what's happening on that deadline that we talk about. But again, we're trying to understand what makes the Australian dollar tick, and we can see here from correlation analysis. Now, the thing that I've looked at as well is bond spreads. So if I go back to that previous chart here about what causes markets to look at, we look at relative rate differential and yield curves, relative rate differentials. We can see that quite categorically here. So what we've seen here is looking at domestic rates, and I look at the bond market very closely. I used to trade fixed income through a US bank, and we're seeing here the differential between the Australian dollar 2-year bond and that of the US 2-year Treasury. Now, the importance of this is that we can look at the rates market, and we might look at the swaps market, or 30-day interbank market against the Fed funds future or the Eurodollar future. A lot of you probably wouldn't have traded too much on the interest rate markets, but we can use the bond market as too. I mean, what we're doing is with a 2-year bond is it's looking at all the expectations around rates over a 2-year period, and that's why I've chosen to use a 2-year bond rather than a 10-year bond. It's encapsulating that short-term pricing much more readily. And what we'll see here is that the Australian 2-year bond trades at a discount to US Treasuries of 77 basis points, so 0.77 of 1%. When Australia outperforms, if that yield moves lower relative to that of the US, it's showing that growth in Australia and interest rate expectations are falling faster than that of the US. And what I like to look at in this chart is the idea about whether the Australian dollar is looking outwards or it's looking inwards. Is it looking at domestic factors? And now what we saw through this period here of May is that the Aussie dollar was following rate differentials quite closely. And then as we went through this period of October into December, that meant absolutely nothing at all. People didn't even look at that whatsoever. And that was the case through the beginning of the year. We were still looking very closely at the Australian dollar being purely at what was happening in emerging markets. We were taking all the variability of the Australian dollar from what was happening in emerging markets. It couldn't care less about what was happening in the Australian economy. It was all about what was happening abroad. And the Australian dollar was purely a vehicle for trading emerging markets. Now, look at what's happening now with a situation where we've broken down against the Hang Seng. Okay, so we've still got a correlation with the Chinese currency. But when we're looking at the broad suite of emerging markets, it's broken down. And we're looking much more closely at domestic factors. You can see that bond spread has cleared up much more closely. And that's taking a much clearer understanding about interest rate pricing in Australia. So I know now that the housing market domestically, this feedback loop between declining asset prices in Australia, business confidence, wages that we're going to see tomorrow, they all mean a lot more. And therefore, we've got to take a much clearer view about what's happening in domestic factors. And what is the key thing that we're looking for at the moment? Is this feedback loop? You've got to read what the RBA is saying. What is going to be the trigger for the RBA to cut rates? Now, we know it's probably unemployment creeping up, but that's a lagging indicator. So it's got to be things like inflation expectations. It's got to be things that, the falling asset prices are starting to really impact business confidence, Westpac consumer confidence numbers, those variables there as well. And that feedback loop between falling asset prices and the perception of people's wealth, credit, all those factors are going to see the RBA cut. Now, the market's already pricing in one rate cut. But what we can see here is that the market, the Aussie dollar has become much more closely aligned to relative rate differentials. How does the bond market see themselves relative to US rates? And that's much more domestically focused rather than internationally focused. So what I'm trying to do here is just give you a quick exercise in me and the way that I think about if I'm going to trade the Australian dollar. Going back to that cycle of fundamentals is what is actually making it tick. Is it leveraged to an index, and therefore why would it do that? Is it leveraged to another currency, and why would that do that? Is it leveraged to its terms of trade, and why not? Is it leveraged more to domestic factors and relative interest rate pricing between Australia and the US, or Australia and Europe if you're looking at Euro Aussie? And what we can then say is what's important in the future. We're trying to understand what it's sensitive to. So now I'll probably just finish off with a case study on gold, because I think that's quite an interesting situation at the moment. I mean, if you have a look at what's been happening in the gold market, and I've been fairly bullish on gold really I want to say since the lows, since probably about November time. I put out a note to a lot of people on the daily fix about gold, and I think that's still something that I think quite openly about, that there's still some decent upside playing through in the gold market. And as you can see here, we've had a really nice move up in the gold price. It sort of trades quite nicely in the technical levels, but you've got this double top in play here. And what we also look for is whether gold's going up in other currencies. And for me, when I'm looking at gold and I'm looking at the charts, so we offer it in gold in Aussie dollar terms, we offer gold in euro terms. What I want to look for first and foremost is gold going up in all currencies, and then secondly, if it is, then that's about as bullish as it can possibly be, because it looks like it's acting as a currency in its own right. What is the weakest currency out of the three that we offer? And that's where I'll probably be looking to buy it. So it's not just about buying gold in US dollars, which most people do. Is if I think that the Aussie dollar is going to go down this year, then I'll buy gold in Aussie dollar terms, and that trade's working out quite nicely. So the rationale that I gave is this. So what I'm trying to do is put this back into the functions about what we talked about there. So I want to identify. So I'm just trying to bring this all back to home to understand how this all fits in into the process. So the first thing I want to do is identify the thematic. Is there an event that we trade around in that cycle I talked about? If not, what is the theme? What is the opportunity that we have? I want to assess the probability then of a future move, and what would be the key risks that get it there. I want to understand positioning. I want to understand sentiment around it. Is it too extreme? Is it too pessimistic? Then I want to understand, once I've got that situation, is if I take a view on an asset, does the market agree with me? And that's the most important thing. I can have a fundamental view, but if the market doesn't agree with me, if that body of cash capital completely says the opposite, then I'm going to follow the market move. When we're trading short-term leverage products, you can have a fundamental view, but if you can see the market already saying that view is in agreement, that's when we're increasing the probability. Of course, then you've got the major parts of trading, which, as you can see right here which I put from my pie chart of what I think is the most important things out there. It's your trade management, your execution of your process, your entry level, your correct position sizing, and ultimately at the end of your process, whether how rate yourself and what you could do better. How much risk to apply on the trade? I actually look at implied volatility, look at the level of the implied move over a period of time, and ultimately from that perspective, I'll be able to work out how far away I put my stop loss. How far away I put my stop loss will determine what the sort of position size I can take on. I'll execute my trade, I'll manage, and I'll review that. So that's really kind of the process, a very simplistic process about how I work. Now, the process is the most important part. As a trader, we all need a process. So for me, it's identifying a thematic. Where is it in the cycle? Understand the probability of a future move. What are the risks? What are the key dates on the calendar that could cause a move? How sensitive is the market to that situation, as we saw from the Australian dollar? I'm having a look at positioning. I'm having a look at sentiment. I can have a look at the commitment of traders report, for example, in FX markets. I can have a look at risk reversals in FX markets and understand the sentiment. I'm looking at the technical setup. What does it tell me? What are the levels I need to look at? Where can I put my stop loss? How much risk do I take on? How far away do I put my stop loss? What is my correct position size? I'm executing the trade, I'm managing the trade, and I'm reviewing the trade. That to me is a very simplistic process. But if I came back and I met any of you guys in the pub and you said, Chris, how did your trade go? And I'll be like, really, 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 really good. And the first thing you're going to ask me is how much did you make? And I'm going to say, well, actually, that's not necessarily the right thing to ask. It's how well did you follow your process? And if I can come back and say, I followed the process really well from start to finish, that to me is a good trade. That as a macro trader is the best way to think about this situation, rather than necessarily just going, I made 5%. Fantastic. Of course, that's what you want to do. Your primary goal as a trader is to grow the capital in your account and manage the risks around that. But ultimately, if you have a process identifying trades, understand positioning, risk sentiment, all these kind of factors, you should adjudicate yourself and judge yourself by how well you followed that process from start to finish. And if you followed it really well, that to me is a good trade. So that's my process really in this situation here. Now I'm looking at the fundamentals in the market. And this is kind of what I'm thinking at the moment. Yeah, the markets, equity markets have been really strong recently. So let's go back to a chart of what should we have a look at? Let's have a look at the Chinese market. You can see the A50 it's had this really nice move up, about 18% from those lows, which you can see here. The ASX 200, we've had this really nice move up from 5,400 up to this ceiling now at 6,100. We're sort of consolidating. We had a little cheeky poker above the precipice there. We didn't really like what we've seen. We just need a bit more evidence to push us through. 80% of the time, these kind of patterns will rectify themselves in the direction of the trend. But, if we do see a close below the 5-day EMA and then we sort of see a make a lower low, this market could feasibly roll over. You'll see that in the stochastics. It'll come down. But this market's had a nice run up. The equity markets have had some really good moves. Let's have a look at the German DAX. I mean, German DAX is looking really good at the moment, but we're coming up to this confluence of resistance levels at the moment. If price can get through, the horizontal resistance and the downtrend here, I think we'll probably make a pretty quick move up down, to 11,800 and perhaps even higher. I think this market feels like a coiled spring. If we can get a break of this confluence of resistance level, I think the DAX is going higher. But either way, these equity markets are all, we can have a look at the Russell. Look at that beautiful move up. I'm thinking to myself, can this continue? Well, perhaps it can. I mean, there's so much cash on the sidelines, this fear of missing out, position situations. Equity markets can move higher in this situation, and we're testing some key levels. But that is very much an equity story. If I go to this chart here, the rates market's not buying it. It's not buying it at all. Look at the S&P here, the yellow market. Again, this is the Bloomberg chart, but you can see the S&P's moved up. But look at the rates pricing. This is the US interest rate market. So I'm looking for all my charts. This is the thought process that I'm thinking about with fundamentals. So if I have a look at the rates market, I can have a look at the euro dollar market and see what's priced in between March of this year and December 2020. So between this year and 2020, we can see that the market is pricing in 16.5 basis points of cuts. So that's negative 16.5. So I can work out what the market's pricing in. Market's saying, yeah, look, we had probably a strong correlation before. You can see rates pricing's coming out the market with the white line there. But then something changed, and that something was Mr. Powell deciding that he wanted to support equity markets. We can't let the world go into a recession. We've got to support equity markets. And they had the equity markets back. As soon as the equity traders realized that the Fed put was still very much in place and that the Jerome Powell had bent over for the market, you saw a situation where the S&P rallied, but the rates market said, no, this does not change the story at all. This does not change what we're hearing out there. And that is that the economy is still very, very vulnerable. Have a look at the New York Fed probability chance of recession. They use this by looking at the difference between 3-month Treasury bills and also what's happening in the 10-year. There's a model that they guys use, and you can actually go to their website and they actually show this. And they see about a 25% chance of a recession playing out over the next 12 months. I think it's actually probably slightly higher than that myself. I'm sure there's people out there who think that's probably closer to 100%. But you can see here that at this stage, this correlation broke down. The rates market said, okay, you can have your fun S&P, but we're not buying this. The fact that the Federal Reserve said that there's going to be a pause and potentially look at their balance sheet as a reflection of the economic fragility, and we still think on balance over the next year, they're going to cut. If we have a look at the rates market again, now look at this situation. If I look at what's priced in between March of this year and December of this year, we've got 4 basis points of cuts. Actually, that was a couple of days ago when I put that in. It's actually around about 4 basis points of hikes now. Now, if you have a look at what's priced in for 2020, we've got about 17 basis points of cuts. I looked in that previous chart between March of this year and December next year. But have a look at this. This year, we've got rates on hold. Next year, we've got 17 basis points of cuts. Now, the important situation for me here is what is the rates market telling me? Have a look at the Fed funds market. This is the interest rate market for the US. Over a cycle from 1970, the Fed funds goes up aggressively. See a little bit of a pause. the Fed cuts rates into a recession. This red line here is a recession mark. Fed funds goes higher, they cut into a recession. Fed funds goes very high in 80. Paul Volcker. They have to cut into a recession. Fed funds goes higher, a little bit of a pause, cut into a recession. Pause in 2001, a little bit of a pause for about a year, big cut into a recession. Pause, very long pause there in 2008 into a recession. What's the rates market telling me right now? The rates market's telling me for the next 12 months that we're on a pause, we're followed by a cut. The rates market's telling me this exact model is going to play out again. So how do I want to think about this? Well, gold. I think gold is a great hedge against economic worries. Now, if we do see equity markets continue going higher and central banks pump liquidity into the world and economics respond, yeah, then gold will be probably a very bad place to be. And I can prove that because if we have a look at this market here, we can see a correlation between the gold price, which is conveniently in kind of a goldy orange color there, and the total amount of outstanding bonds in the world with a negative yield. And you can see that the gold for large periods of time, okay, there was a bit of a breakdown in correlation in this kind of period in June 2018, but now we've seen this pool of negative yielding bonds increase, and that is a reflection that inflation expectations are falling. The rates market sees an increased chance of a recession, and if economics around the world continues to devalue and continues to weaken, this correlation will continue to work, and therefore this pool of negative yielding bonds, and effectively, that is a reflection of economic stagnation playing through. Gold is working very well as a hedge. So we've already got our story playing through, which is that the rates market's telling us there's going to be an increased chance of a recession in the US. There's a growing degree of negative bonds around the world, which are a reflection of slowing economics and lower bond yields, and gold is correlated to that. If I have a look at what we think is going to happen with the balance sheet in the Fed, and this is again another chart that I've been pulling out quite a lot recently, you can see here the US dollar index, which is the red one there, and excess liquidity. Now, excess liquidity is derived from the Fed's balance sheet. If the Fed's balance sheet is falling, the amount of excess liquidity in markets is falling as well. Now, I've actually inverted this, so you can see this green line is actually going up, but actually in reality it's going down. So you can see the excess liquidity is falling. Of course, in that situation, it's great for the US dollar. So we can see here in this run that excess liquidity is falling. In fact, it's picked up a little bit recently, but the US dollar is following what's happening in excess liquidity. Now, there's a bit of a lag here. I've actually lagged that by 3 months. So we can see that the US dollar is starting, has had a very, very strong correlation to what's happening in the Fed's balance sheet. So what do I do now? I'm thinking to myself, immediately my head's churning out. I'm like, well, okay, we know that probably in the May-June meeting, they're already starting to talk about announcing a terminal size for the balance sheet, which effectively means that they're going to stop their balance sheet going down, which is going to have big impacts on excess reserves. Now, if they stop that balance sheet normalization, excess reserves are going to do this. This green line is going to continue going down, and therefore, look at the dollar. What's going to happen to the US dollar? It's probably likely to fall as well. So we take a view on what happens in the Fed's balance sheet, and from that perspective, we can make a view on what's going to happen with the US dollar. My cleaner's going to come around in a minute now with a very loud hoover, so I'm going to have to ask her very kindly to please avoid this area. So just hold with me a few seconds in a minute. And we can see, therefore, that what's on my radar, it's very much around, have a look tomorrow night at 6, or tomorrow, Thursday morning at 6 o'clock. We've got the Fed minutes. There's going to be a big discussion around what happens with the Fed's balance sheet. And what we can see here is the size of the Fed balance sheet will determine excess reserves. And we can see that the US dollar is very correlated to that. And if we can take a view on the US dollar, perhaps we can take a view on gold as well. We can also see, look at rate pricing. Rates are coming out the market in Australia. Rates are coming out the market to an extent in Europe, although they're sideways recently. Rates expectations have been coming out in Canada. They've certainly been coming out in the Fed in the US. We've already seen that. And we already know that the Chinese are doing everything they can now to promote money supply growth. The point being is that I'm thinking to myself, what currency is going to do well in 2019? It might not be the US dollar, although the US dollar could have some attractions. It probably isn't going to be the yen if this low yield environment continues, because you want to do the carry trade. Is it going to be Australia? Well, it could be the Australian dollar, but there's so many risks around the housing market that at this stage it's not really that attractive to own Australian dollars, and it's certainly not attractive to own euros when the ECB are about probably to announce a new TLTRO, cheap liquidity, expand its balance sheet, and increase base money. And also, you've got a technical recession in Italy, and Germany's got zero growth. So why on earth would you want to hold euros? Canada's got some attractions, yeah, but it's not really that great. The pound, well, it could be really good if Brexit has a positive resolution, but I think if you look at the UK political situation, it's fragmented. The point being here is there's not really any currency in G10 that makes me want to buy anything with any kind of categoric situation. So gold has been going up in pretty much every currency. Why? Because gold is being used as an alternative currency. It's being used as the best of a bad neighborhood. And you can see that situation is. If I thought that there was attractions for all currencies in G10, gold would probably be going down. But we can actually make an assumption that pretty much there's not a currency in G10 that I really want to own with any major conviction. Yeah, I'm going to trade in and out of positions, and that's going to be the situation. But at the same time, I think gold is looking quite attractive in its own right. So I think that's a really big assumption. If we have a look at the current account deficits in the US, and if these are cities numbers, when we look at the twin deficit between the government balance and also the current account, and most people's assumption is that that's going to continue going down, and it's going to go to a really pretty punchy deficit, about 7.5% of GDP. And if you can have a look at the dollar, this is the Fed's dollar index, which is you can tell her to, you can see that the US dollar is very correlated to what's happening there. Now, if you have a look on Citi's assumptions, that deficit's going to get down to about 7.5% of GDP. Where do we think the US dollar is going to go? If you think that this correlation has been in play with a bit of a lag, it's probably lower. So again, what am I thinking here? I'm thinking, do I want to be long gold in dollars? Do I want to be long gold in euros? Do I want to be long gold in Australian dollars? Well, the evidence suggests that over the next couple of years that the US dollar's got some big headwinds. Now, I'm not going to go into the primary dealer take up. The next thing I'll look at is which has been the weakest currency there. And you can see the New Zealand dollar as of the 15th was the strongest. The British pound was the weakest currency. The euro was pretty weak. We offer gold in euro terms, Aussie dollar terms, and US dollar terms. So the euro is probably the weakest of these three currencies. So again, what I'm trying to understand is what is making it move. Well, we can see here from this negative yield chart that gold is being used as a hedge against a ballooning pool of negative yields in the bond market. What's causing those negative yields is economic uncertainty and fragility in the economic environment. If Donald Trump decides to pull the trade war, you are going to see this pool of negative yields increase. What currency do you want to be long? Probably gold. What's going to happen to volatility? It's probably going to rise. Well, it definitely will rise. What's going to happen? We want to be in gold. So again, so I like gold in that situation. All of these points to a situation where gold could appreciate. Now, that's my fundamental view. The most important situation is, do the market agree with me? I am no bigger than the market. The market is 10 times the size of I am, if not more. The most important thing for me now is does the market agree with my assumption? Pretty much. You've got the market making higher highs. It's doing everything right. All of these things that I'm thinking about, the market is saying we want to be involved in that situation. You can see gold in US dollar terms breaking out. In fact, if we get a close above this level here, it's going to say this continuation period. It's holding all the different moving averages we can look at. Again, that just shows the trend. Stochastics are moving higher. A break of this level when we see a continuation pattern. What then I'll look at is I've got my fundamental view that gold is, I understand what's making it move. I like the story behind it. The technicals are looking really bullish. We add on a break of these levels here on a closing basis. I'd look at the implied volatility in gold, which I don't have right now. I'd look at the potential move over the next month, and I would say that's kind of the risk. But, ultimately, you'd probably be looking at a situation where you might put your stop loss, below these lows here, and you understand that I'm taking $27 worth of risk. What does that mean? How much can I potentially lose? And in that situation, I'm in the trade. So I'm in a trade. I like the technicals. The technicals look great. There's a really strong trend. I like the fundamentals behind gold. It's being used as a currency in its own right, in the best house in a bad neighborhood. It's a great hedge against economic concerns. I like all these facets that are playing through. I'll look at the positioning in the market. Is it too stretched? Is it positioned too euphoric? And unfortunately, the commitment of traders report has been put on hold because of what's been happening in the government shutdown. But we'll see a situation probably where, holdings have become quite rich, but they could get more rich. In that situation, we're looking to add. Now, for me as a macro trader, you're going to get probably 2, maybe 3, 6 to 8% a year. That's what you're looking for. I'm going to have a series of very small profits, very, very small losses. But ultimately, I'm going to have 2 or 3, 6 to 8% as pre-leverage that's going to make the bulk of my P&L work. So I can have a 45% success record. I could have a 40% success record, a win-loss ratio. But the money that I'm going to be making on at least 2 trades are going to be, 8% pre-leverage, perhaps even more on a highly leveraged product, 500 to 1, for example. Maybe gold's a bit less than that, but that's what you're looking for, and that's going to be what's going to drive the P&L. If you work for a macro fund, you are looking for at least 2 trades of about 8% to get that situation, and that's the hardest part of trading. It's when we go back to the slides, and I go back to my process, I can identify the theme. What's the theme? Well, we're seeing a global deterioration. There's no currencies which have really any kind of benefit, which I find really compelling. What's the probability of a future move? Well, we've got to take an understanding about what happens, with what's happening with Euro-China relations, what's happened with the global economy. Is it going to pick up? I haven't looked at positioning and sentiment, but I would do using software that I've got. Access the technical setup. Well, yeah, it looks bullish. I'm happy to be long gold because the technicals look fantastic. How much risk to apply? Again, I'm looking for my stop loss, enter correct position sizing. I'm executing the trade. That's the easy part, of course. It's the managing the trade that is really, really hard, right? So you probably would have heard that traders are risk managers and we are managers of losing positions. I don't agree with that. I understand that we are risk managers. We are always assessing risk. I think that's absolutely right. But what I find it very easy to cut out of a position if it's not working, and I look at my account and the position's losing money, and I look at the chart and I say it looks bad. I don't want to be involved in this. I'm missing an opportunity. It's easy for me to cut out the trade. A lot of people find it very difficult to cut out of a trade, and that's what ultimately we'll see retail traders lose money and end up closing their account. But I find it very easy. I'm not trying to say I'm a great loser, but I find it very easy to cut out of a trade. What I find is more difficult is this idea of letting profits run, and you get people coming out and saying, we're managers of losing trades. The profitable trades take care of themselves. Well, I think that's absolute nonsense. I think that's bullshit, to be honest, because if I'm looking for that 8%er, the hardest thing in the world to do is let your profit run when the market starts turning. The emotion to close out of that trade is impossible, and that's the hardest thing. Do I go into the trade looking to add to my position size? That could change my mentality, but getting the most out of a trade is I think the hardest thing. So I find it very easy to cut out of a trade when it's in negative territory. What I find very difficult, and what I think a lot of people find very difficult, is to try and go back to this risk reward capacity. And this is the basic maths in trading. All the retail traders think about the win-loss ratio. It's not the way to think about things. We need to think about the risk reward before we think about win-loss ratio, in my opinion. So I might only have 40% of my trades right, but if I'm going in, I can afford to get, I can go in at 1.5 times R, and I'll make money out for the course of the year. In an ideal situation, I want 2 trades which are going to give me 5 times what I'm risking. I want that 8% trade. And that's just really, really hard to let that profit run, let that position run until you get that situation. But that's the thing, that if you can get that right, you are going to do well as trading. And that's why people lose money trading. One is that they don't try and improve, and they try and understand what they're doing wrong. That's what we see all the time, regardless of the broker you work for, whether you're a professional trader or greenish trader in the world. The reason people don't make money and why they blow their accounts up is because they're just not prepared to learn what they've done wrong. But yeah, the idea that you can cut out the trade early, I think that's easy. The hardest part is actually letting that profit run when you know that you've got to crystallize a position that's a profitable trade. That's the hardest thing I think that anyone can master in trading. I find it difficult. Systematic guys don't find it difficult because they've got a system that does it. They've got an algo that does it for them, and that's a fantastic position to be in. But what I'm looking for in that situation with the gold trade is trying to just let it run without feeling like if that market rolls over, I'm going to have a losing trade. But everything at the moment is suggesting, look at the model that the rates market's telling me. It's telling me that the same textbook situation is going to play out again. What is going to save it? Well, okay, the Fed have done a 180 turn. They've done a 180 turn on their balance sheet. They've done a 180 turn on rates. The rates market's not buying it. The S&P is. The S&P loves it. But the rates market hasn't changed whatsoever. Are we going to see a weaker US dollar? Well, the fact is we're going to see a change in the balance sheet composition, and that suggests that this correlation continues, which it has done for 8 years or so, that it will do. You go to this chart here of what's happening with the trade deficit. That needs to be funded. Who's that funding going to come from? We can talk about primary dealer take up another time. But this correlation, which has been in place since 1975 with a 2-year lag, suggests there's downside in the US dollar. Is that going to be good for gold when it's mixed in with a US recession? Hell yes. So I'm looking at this situation. I'm buying at the moment in euro terms because it looks fantastic in euros. But if I have a look at what's been going on longer term, I'm looking at what can happen in gold in US dollar terms. So that's my thesis. That's the process that I'm looking for. That's the whole point of today's webinar is understand what is making something tick. Are we in a situation where that thing that's making it tick is in a deadline driven cycle? And what part are we in the deadline? Is it stage 1? Is it around that stage 2, which I want to be out of? Or is it in that stage 3 where we know the fact and we can trade around that? At the moment with gold, the good thing is taking off that situation with US trade, and that will change the dynamic, and we will look at that. And I think gold's probably trading in that phase 1 as we go into the deadline. But it's also going to have an interesting investment case longer term as well. And then I'm trying to assess all the probabilities that go through. So when we're trading around fundamentals, it's not necessarily about earnings. It's not necessarily about the present value of a company based on discounting. To me, it's about what are the factors that make it work and what is it sensitive to, being really categoric about that. And then looking ahead at your calendar to see if those thematics are going to play through and whether you want to be exposed to those events, and what if it comes out, the different permutations, what it could mean for those assets going forward. So I just want to give you a little bit into the mind of how I think as a macro trader, the cycle which I think markets are working in at the moment, the stage 1, stage 2, stage 3, and how we think about that the impact of volatility on positions as well. So really that is just a little bit about how I think we can combine technicals and fundamentals. But most importantly, if what I've said with the fundamentals is all a little bit too hard and you don't have the capabilities of getting hold of that, and you can always get in touch with me and I'll be happy to help out where I can if you're a client. Remember, the most important thing is what the market's telling you, and that is reiterated in the technicals, it's reiterated in the price, it aggregates all known news. Now, you can trade along with that, but for me, it's about understanding what something's sensitive to, what could be the event risk going forward, and how that could move markets. Royston, you've written, do Pepperstone show articulate regular commitment of traders reports? We haven't done. Look, we can do. It's something that I could definitely put on my my daily fix. What I've started to do, though, I think might be interesting in every Monday is put the implied volatilities of various the key FX pairs, and I'm going to start putting various indices in gold as well, overnight and also 1 week. And what that does is it tells you which currencies are expected to be the most volatile, but ultimately, what is the implied move over that period, and therefore we can assess using that implied move how much risk we can take on. So I don't necessarily use it as a mechanism to speculate. We don't offer options, but we can use that implied move over the week as an understanding about how much risk we can take on in each position. So that's something I put in my daily fix every Monday, which I think is quite helpful. But I can certainly look at the commitment of traders report. The other thing which I put out quite a lot in my reports is gold is risk reversals. Now, risk reversals are effectively something that, again, this sort of is an alternative to the commitment of traders report. The commitment of traders report looks at futures positions, whether you're FX futures or E-mini futures or oil futures or whatever it's going to be. And every Tuesday, money managers, different types of money managers, have to report that to the CFTC, where it gets aggregated into their different types, whether you're non-commercial or whether you're a leveraged fund or whatever you are. And then there's a net position. So you work out whether a market's significantly long or short on a certain commodity. The other one I like to look at here is risk reversals. So what the risk reversals do is it looks at the skew of put volatility to call volatility. So, of course, if the volatility of a put is higher than that of a call, it shows greater demand for put options. Now, they will look at the same delta, 25 delta, and they'll look at the same expiry. And therefore, we can have a look at the skew here on gold on this right-hand side is 1.44. So that's telling me that that's a positive skew. So that tells me that there's been a lot more demand, or the call volatility is much higher than that of put volatility. That tells me when you're buying calls, of course, it means it tells me that people have been, when you're buying calls, of course, it means you're betting on upside in the gold. So what you can see here from 1 month is that over 1 month options, which give you the right to buy or sell over a 1 month expiry, that there's a skew of 1.44 times of the volatility. So it's not extremes by any means. If we get up to a 3 times skew, then that would be fairly extreme. But you've got at 1.44. So that tells me that the options market, which I think is much more liquid, it's reported every day as opposed to the commitment of traders report, which is reported every Saturday for us here in Australia, every Friday night in the UK and in Europe and the US. But this tells us much more radically that what's happening in the demand for call options relative to put options. Again, I think this is a really good sentiment driver. We can also have a look at the total holdings of gold in ETF funds as well, and that's near record highs, but not far off. So what's my email address there, Jared? chris.weston@pepperstone.com, or reach out to me on Twitter, chrisweston_PS. But do sign up to the daily fix if you're not on it already, and I'm always keen to get into banter with clients as well. If you're not a client of Pepperstone, feel free to sign up to a demo at least, and I'll be happy to help you out with anything that you think that might make you a little bit more profitable. But yeah, we can have a look at the commitment of traders report. I can certainly put that in there, but personally, I like to look at the options market. I can look at 1 week, one overnight. I can look at 1 month, 3 month, whatever it's going to be, and look at the demand for calls over puts. And again, that's something that I do put in the daily fix. So yeah, I realised that to a lot of green clients, some of the stuff I said today has been probably quite complicated, but I wanted to come at this as an angle of how the institutional funds will look at fundamental trading, and these are the kind of things that you can take away and actually try and improve your trading. But if your fundamentals and technicals, or just technicals, understand where we are in a cycle, try and understand where we are in a cycle. The closer towards that situation, the more volatile things get. Volatility can affect your trading. what are the news flows that's going to come through? Will it affect your algo? Will it affect yourself? And what does it mean for your positioning? But again, it reads into the idea of assessing probabilities, assessing risk. Do you want to be in the market when that risk is happening? And so, I hope you got something out to it. I'd really be happy to hear anyone's views. If there's anything that you like to do that you think that I'm missing, feel free to reach out to me, and it'd be good to hear from you. But anyway, so you'll get the recording soon. Thanks, guys. Appreciate you spending an evening with me.